Welcome to my video Accounting Tips for Beginners. In former videos, I presented how to learn accounting definition in simple way, what are the various branches of accounting, how to learn accounting equation with three basic accounting terms, and various uses of accounting information. From this, we can say that accounting is the language of business to be communicated irrespective of their status or nationality. Therefore, uniformity in the preparation of financial statement is essential. There are certain guidelines and rules for recording the transaction. So, in this video, I would like to introduce a core topic that means certain guidelines and practices that are followed while recording transactions and in preparing financial statement. Let us see theory base of accounting, which is otherwise called as generally accepted accounting principles and practices. Based on these, the theory base of accounting comprises of basic accounting assumptions, basic accounting principles, modifying principles, and accounting standards, which are generally referred as generally accepted accounting principles. These are the certain guidelines and practices that are followed while recording transactions and in preparing financial statements. Such guidelines and practices have been developed on the basis of globally accepted accounting standard. Such principles are called generally accepted accounting principles. Based on these, principles are classified into basic assumptions, basic accounting principles, modifying principles, and accounting standards. Let us see basic assumptions. What is meant by basic assumptions? Assumptions constitute the foundation of accounting. They have been developed by customs, traditions, beliefs, and practices by accounting practitioners. It lays down the general principles to be followed while preparing financial statements. It is due to the general acceptance of those accounting assumptions, accounting has become comparable, reliable, and relevant. There are four basic accounting assumptions. They are accounting entity or separate business entity. Let us understand accounting entity, which is otherwise called as separate entity or business entity. Accounting entity or business entity or separate entity. According to this assumption, business is treated as separate entity that is distinct from its owner. Let us see the effect of accounting entity concept. The effect of this assumption is that capital is treated as liability, drawings is treated as assets, profit is treated as liability, and loss is treated as assets. Now let us understand the money measurement concept. As per this concept, transactions that can be measured in terms of money only are recorded in the books of account. The effect of this money measurement concept is human resources, which are greatest assets of a firm, cannot be recorded in the books of accounts since their value cannot be measured. Next, going concern concept. As per this concept, the business unit is assumed to have an indefinite life. It is deemed that there is no intention or necessity to wind up the business activity in the immediate future. The effect of going concern concept is assets are classified as current assets and fixed assets. Liabilities are classified as current liabilities and fixed liabilities. Expenditure are classified as capital, revenue, and deferred revenue expenditure. Receipts are classified as capital receipts and revenue receipts. Outstanding expenses and income received in advance are treated as liabilities. Now let us understand accounting period or time period assumption or periodicity assumption. According to this concept, economic life of an enterprise is artificially split into periodic intervals which are known as accounting period. So it is also known as periodicity assumption or time period assumption. Let us understand the effect of this accounting period concept. Financial statements, that means trading and profit and loss account, are prepared as per this concept. From this, we can conclude that basic assumptions of accounting standards implies accounting entity or separate of business entity, money measurement, going concern, and accounting period. These are the four categories which comes under basic assumptions or concepts. Thank you for watching this video. If you like it, you may subscribe it and mention your comments.